Yeah, here we are. Pretty fancy there, wasn't that? Hey, welcome everybody. Give you just a second here to pop online. We're on time. It is actually 6 o'clock here on Tuesday evening, and we do this every other Tuesday right here, streaming via Restream on all your favorite social media platforms. So you have a choice where you can watch this. If you signed up in advance, thank you for that. If you're just hopping on because you're seeing it live now, that's great. And you may be seeing a replay of this. So welcome. We're glad you're here. My name is Bruce Cline, and I'm a senior loan originator with Oz Lending and bruceklinemortgage.com. And here is my lovely guest host. Let's go ahead and get her on screen here. Ashley, introduce yourself.
Hi, hello, everyone. This is such a great information-packed full webinar. Our next show is August 23rd. That's in 2 Tuesdays. Make sure to share this with everyone in your conversation database that's having, conversations about the market, about buying investment properties, about buying their first time home property. Share this video. I know you're talking about it. Everyone's talking about the market. So I'm your realtor, Ashley Westbrook, and super excited to be with you guys tonight. So share with all your friends who are looking to take that leap into home ownership.
Absolutely. Thank you for that. And let's get our screen up here. Before we dive in, I just thought I would go ahead and share something with you all. Since everyone is talking about the market, is there a housing bubble? What's going on? Those of you who are Dave Ramsey fans, and even if you aren't, you know who he is, love him or hate him. This is what Dave just recently had to say about this market. Right now is the best time to buy a house in the next 5 years. Why is that? Because prices are not going to go down. Okay, they're going to go up slower, but they're not going to go down. So if interest rates go down, you can refinance into a lower rate, but don't wait on buying for interest rates to come down. He also says this: the root issue of what drives home prices almost always is supply and demand. So when interest rates go up, demand goes down and prices begin to soften and not be so crazy. That's what we're seeing now. So if you 3 months ago, 4, 5, 6 months ago, if you were out on the market, you were trying to buy a home, you got frustrated, there were multiple offers, prices were too high, you were getting priced out. The market has shifted a bit, and so now maybe, listen, come back and revisit. And here is why. If you are renting, you can't take advantage of this. What the screen is illustrating here is the potential growth in home equity over the next 5 years. That's how much value is going to increase, okay, in your home. So in this example, it shows a home purchase this year at $390,000 purchase price, right? Loan amount. So check this out. That purchase price at $390,000 on an average of a 5% increase, which is standard before we've seen these crazy price increases over the last 2 or 3 years. 5% is kind of standard. Now, there's, depending on who you look at, it ranges anywhere from 4 to 12% is what's being estimated. So we're just going to go on the safe side and say 5% here. If this home was purchased at $390,000, you would earn $102,000 in equity over the next 5 years. That is money in the bank. There's no other way to save that I know of that kind of money. If you're making, hundreds of thousands of years, maybe you can stash that away. But for the most part, this is you owning a piece of property, your home to live in. And instead of paying that rent and making your landlord wealthy, you're earning equity that sits in your home like a bank. You can turn that equity into a new home. You can pull out equity in a refinance and pay debt off, college tuition, whatever. But listen, it's a great start. Now, that being said, let's get started with, let me get that going. Let's go with this one. Let's get started with our presentation. Thank you again for being here. So, buying your first home, what's it all about? We want to help you understand how to get that mortgage, how to pre-qualify, and understand the process, what all goes into it. You're going to learn the advantages of owning a home. We're going to explore different loan programs, discuss the cost of being a homeowner. You're going to understand how your credit scores affect your loan options. We're going to show you how to complete the pre-approval process. And then finally, we'll answer any questions that you might have. And by the way, if you want to type a question to us, just go over to the chat. And let me see if that's open. Yeah, so if you have any questions, go ahead and type your questions in the chat, and we'll get back to you here as we round out this session. Now, moving on. So why should you buy instead of rent? You know, Ashley and I are in this business, so we often think, duh, this is obvious, right? But, you know, to a lot of you, it might be intimidating to own a home. You don't know what happens. And honestly, when you go from owning from renting an apartment to owning a home, and you have any issues or whatever, in an apartment, you call the office, right? Hey, my air conditioner's not working. That's gone when you own a home. That's all. You will have a list of vendors you can call on. Your AC repair, your plumber, electrical, all those things. And so that will then fall on you. And we can talk to you about what you should do to protect yourself, like, home warranty insurance. So if you can cover utilities, something breaks, it's got to be replaced. An insurance through a company can help you offset the cost. So it is a wise investment. I just showed you how it can increase in value. If it goes up at 5%, the thousands you're going to be saving in your home equity in your bank. And that's what we're talking about in section 3. The interest paid on the mortgage, okay, on that interest rate is typically tax deductible. You will want to speak with your CPA about that when you file your taxes so you can write that off. You can personalize your home, make home improvements. Anything you want to do to that home, that is yours. If you're expecting, you're getting married, you're going to have a growing family, that you can make room for that. And as I already mentioned, a starter home is a great way to begin building personal wealth and then generational wealth as well. Stop paying someone else's mortgage. You're making your landlord rich when you could be building wealth for yourself. So how to begin? It's really not that complicated. You probably, since you don't know about it, you think, I don't know how to own a home. Well, that's what we're here to show you. Easily, first, you want to select your home team of experts, right? There are multiple ways you can go about that. We'd like for you to call us. We want to be your trusted advisors. I will say that there are sites out there that I would not go to. I'm not going to mention them by name. Some of them may have lending in their name, and they're not really a lender. What they do is they gather your information, and they sell it to 30 or 40 lenders. Now, if you've ever seen a tree and all the branches, I'm not giving the name of the company, but it could look like a tree, and it could say lending, and then you might know what I'm saying. I wouldn't go there because they're going to sell your information. You're going to have 30, 40 lenders calling you the second you hit submit. We're not going to do that. We're just going to answer your questions, be available to you, and help guide you through the process. So, secondly, after you have talked to us and ready to go, I'll send you a mobile app that contains my application. You simply fill that out, easy to do on your phone. Once you submitted the application, I'm going to go through it and ask for certain documentation, your pay stub, bank statements, etc., to make sure that you qualify. And also by having those documents, it's going to tell me what type of loan you need to be looking at, and we can explore the different loan options. At that point, you'll consult with your real estate agent about what's available, where do you want to live, and when can we start looking. And at that point, that's when Ashley will come in. And Ashley, you want to address a little bit about what you'll do there and how you'll go about doing that?
So the great thing about getting in touch with your lender first and getting this pre-approval process started is it's the only way a realtor or anyone that has access to this beautiful database called the multiple listing service is going to expose you to it. So the cool thing is once we get the ball started, I have a conversation with your lender with Bruce, and we're talking about terms, we're talking about down payment monies that you want to spend. This is only going to help me to show you properties that meet your criteria, so that I'm only showing you properties that are available today and to go make an offer on and allow you to shop. So you get this beautiful VIP client portal search directly sent to your inbox. And if you're a husband-wife team, we communicate with text message via husband-wife on the same page, and then the same thing with the client portal. So that way, when 25 Pepper Jack Lane comes up and you both have hearts and your eyes get really big and you both love it, you're both receiving that property at the same time. So obviously the next step is to get a hold of me, your realtor, who's going to help you schedule that showing, get you in there, and guide you along the way and show you how to determine a fair offer price for the property.
Awesome. So with that, let's move ahead and talk about the home buying process 101, the steps. So here's the factors of the pre-approval: your credit history. Where do you work? Are you self-employed? Are you a W-2 employee? Doing contract work, whatever it is, whatever that status is. Your qualifying income, that's your gross monthly, gross and annually, before taxes and insurance. Whatever your existing debts are. We're going to talk about your down payment, depending on what type of loan that is, and if you qualify for down payment assistance, which could eliminate the down payment altogether. We're also going to talk about right here. I want to show you the factors that help us determine not only what type of loan you're going to qualify for, but if you qualify. And these are the items that determine your credit score. You may know these already, but most people don't know which ones carry the most weight. So you can see right here in the green, new credit and types of credit counts for about 20% of your credit score, your history. The length of your credit history. So if you've got some lines of credit that have been open longer than others, that helps. That's about 15%. The amount you owe. That's the ratio. So let's say you've got $1,000 spending limit and you owe $500, you're at 50%. They like to see around 30%. 50% is certainly better than 90%. So that is 30%. And then your payment history, look at that, 35%. All right. And so I can't emphasize enough, make those payments on time. And so you ask, well, why is the payment history so important? Well, right here, you'll see the history of making your monthly payments indicates you're likely to make your mortgage payment on time, right? So that's why they're looking at that. If there's a lot of late payments on there, that not only lowers your score and hurts your qualifying, it also means that if you do qualify, you're not getting the best rate. It may cost you more for that rate. Your loan costs will go up when that rate goes down. That's it. So it's going to be a factor in the type of mortgage you qualify for. And it can determine how much is required for your down payment, the amount of money you can borrow, and the interest rate you're offered. So most of these down payment assistance loans, for example, you need a minimum 620 credit score. We'll go over that and what programs look at what different scores here in a moment. So how much do you need for a down payment? That's a great question. You know, first of all, a lot of people think they need 20%. So they immediately eliminate themselves. They think, oh my gosh, you know, $300,000 home, I don't have, you know, that's 30,000, you know, what is it? 20,000, $60,000. Well, most of us don't have that kind of money sitting around unless you've got a wealthy family member or a parent who's going to gift you the down payment. You can certainly do that. But my point here is you don't need 20%. Okay, you can get in with down payment assistance with as little as $0 down. You can get in at 3% or 3.5%. So you also, when talking about this down payment, if you're talking about a percentage, you need to remember, look down here at the green column, you need to remember that closing costs are involved in there. So if you're only factoring in 3% or 5%, you need to add another probably at least 3%, maybe 4% for all of the closing costs, okay? Title fees, the home inspection, the appraisal, attorney fees, recording fees, and that's all going to be listed on your spreadsheet where all the costs are going. So you get a complete breakdown that you'll get to review and see where the costs are going. And there's no sticker shock, nothing can be added. So we'll go with that with you. And I like to send you that spreadsheet in advance. You see it. I can do it. I even will send it in a video. And a lot of times it's easier to understand, but we can certainly get on the phone and go over it as well. How much can you afford? A lot of this is going to be based on, we're going to look at not only your income, we're going to look at your debt. So we're going to determine what's called your debt to income ratio. You might hear people say DTI, your debt ratio, your qualifying debt ratio, qualifying income ratio. All of that basically means how much do you make, how much are your current bills, and I'm talking about electric or phone, I'm talking about your car payment, any student loan debt, if you're paying spousal support or child support, all of that is included in what we have to use to calculate that ratio. So we take your income and your debt payments, we work that on our spreadsheet, and we come up with what your debt ratio is. So certain loan programs offer different qualifying guidelines for expanded debt to income ratios and lower down payments and loan amounts. And we'll talk about those. But an FHA loan, for example, requires 3.5%. First time home buyer on a conventional loan requires only 3%. The more you put down, the better your rate's going to be. But if you're one of those that wants to put the least amount down, highly recommend it. Get in the home. Just get the loan first. You can always adjust later through refi. So moving on, what does a mortgage payment include? This is a good question. Most people probably don't realize that all of these are included. You'll hear people talk about your PITI, okay? Principal, interest, taxes, and insurance. So your principal is that loan amount. So let's say your loan amount is $280,000. That is considered your principal. Then let's say your rate is 4.99. That's the interest rate, and you're going to pay that much interest on top of that principal amount that you're making, the payment you're making monthly. Then you have property taxes. That depends on the county where you are, and it's also, you have school property and school taxes, city taxes. So it's always a little bit different depending on where you are, and that gets added into a monthly. And then you've got your homeowner's insurance, your hazard insurance that covers you in case of a catastrophe. You also, if you're putting less than 20% down, and this is where that 20% number comes in, and most people think they need 20% down, that is only so you will eliminate the mortgage insurance premium. You will have to pay a mortgage insurance premium just like you do on a car or renter's insurance. You're going to pay that as insurance whenever you put less than 20% down, and that just insures the lender in case you were to default on that loan. So, and again, that number is different based on your credit score, how much you put down, and some other variables, as the loan amount, how much it is, how much the cost of the home is. Several factors, and again, that will be on that list, the itemized fee sheet that I'll share with you. Now let's start diving into the different loan types to talk about what might be right for you. Conventional versus unconventional loans. So basically a conventional loan is any loan that's not insured by the government, right? These are your Fannie Mae, Freddie Mac loans. You'll hear about, oh, well, that doesn't meet Fannie Mae or Freddie guidelines. So right here, a little more detail. Conventional loans are backed by Fannie Mae and Freddie Mac. They carry a lower debt to income ratio threshold. As we mentioned before, your income and your debt, we work those together in our spreadsheet to see what your ratio is. Typically for a conventional, that needs to be at 45% or lower. You have higher credit scores or of 680 and higher are preferred for conventional, and really probably closer to 700 and better And usually if you're close to 700, we've got some quick ways that we can show you while you're searching for a home that we can get your scores improved quickly. We don't have to wait for them to recycle 30, 60, 90 days. We've got ways that we can help show you by paying this debt, paying that debt off, or changing the ratios a little bit. You'll get that score where it needs to be, and we can help you with that. So as it says here, it can be, mortgage insurance can be more expensive. The closer you get to 20% down, the less you're going to be paying on that mortgage insurance. You're also, this just talked about the loan limits. Conforming loan limits right now are at 647,200. Those typically go up every year. So if you were to be purchasing a home over that loan amount, then you start moving into a non-conforming, or what's called a jumbo loan, 647, above 647,200. We're talking about fixed rates here, everything we talked about so far, but there are adjustable rates that you can get that get you in at a lower initial rate, which can help you qualify because it's going to lower your payment. So let's say you have a problem with the ratio. If you get into an adjustable rate, you get a lower initial rate, right? So now you qualify. And those typically, they won't adjust for 5, 7, or 10 years. These are great for first-time home buyers, okay? If you're hearing other things, that, it's not. Let me tell you why it's great for you, because most first-time home buyers are only in that first home for 5, maybe 7 years. So that rate adjustment, most likely, well, if you're on a 5-year, it will not adjust before 5 years. If you're on a 7-year, it's not going to adjust. In most cases, you either refinance or you sell that home before the adjustment is ever made. So you are taking advantage of a lower interest rate. Also, you might want to keep that home and turn that into an investment property. Once you've built up equity, you take that equity out, go buy a bigger home for you and your family, and then you keep that home and you put a renter in it. You've got another source of income. At that point, you would be refinancing that anyway. So I'm telling you, man, an adjustable rate is great for first-time home buyers and new home buyers. Now let's talk about the unconventional loans. These are loans that are insured by the government, and you can see here they include the FHA, Federal Housing Administration, the USDA. That's going to be out in more rural areas. There's a USDA map that we can look on to make sure the home will qualify for a USDA program. Those programs are great because they're zero down loans. However, they're more difficult to qualify for. So there's the credit scores and things like that are a little more strict. And then the state bond programs that we talked about earlier, where you can get as little as zero down. You can get 2, 3, 4, 5% down payment assistance. So if you're getting 5% assistance, in many cases, that covers your down payment and if not all of the loan costs. So that amount above, I'm talking about your title fees and all those fees we mentioned earlier. So then you have the VA loan for the veterans. You can be currently an active member of the military, or you can be a veteran. And these loans are excellent. They have great rates. There's no down payment. There's no mortgage insurance. And you put the other loans we talked about, you're going to have mortgage insurance when you put less than 20% down. You don't have it on a VA loan. Now, you will have what's called a funding fee. However, that gets rolled into the cost of the loan, and you don't come out of pocket for it. And for our veterans with a 10% or more disability, that funding fee can be waived. Moving on. Okay, now, which type of loan is right for you? That's why we're going to have that initial conversation. So we're going to get your loan application. I'm going to see your full financial picture. I'm going to see your credit. I'm going to see your debts. And based on your credit score, your qualifying ratio, the debt to income ratio, that's going to tell me which loan programs I need to discuss with you. And so immediately I'll know, well, the score is 650 or whatever. Well, we're not even going to talk about the conventional loan programs. I'm going to show you FHA. or I'm going to show you how to fix that score. If you're not buying for 3, 4, 5, or 6 months, we can work on that and get you into the conventional. But I'm going to show you based on your entire picture and your life situation, the programs that are a good fit for you. I will show you a few, and that's your choice. It has to be the right fit for you, or we're not going to do it. So interest rate is only one component in getting the ideal mortgage that's right for you, right? For example, you don't have that large chunk of money in the bank. You don't want to put 3% down. You want to put the least amount down, right? So guess what? Obviously, that interest rate's going to be higher, okay? But we're not all that concerned about the interest rate when you're trying to qualify for a home with down payment assistance. You want to get into the home, okay, with very little down. You can always refinance that later. A lot of these programs have a 3-year forgiveness period, so you'll have that rate for 3 years. Now, if you pay it off early, I'll show you. I mean, if you happen to refinance before the 3 years or sell that home before the 3 years, I'll show you how you can still do that. You've got to pay that back, but it's not going to come out of your pocket. It will come from the equity that you've built up in your home. So it still may work to your advantage if you're not past the 3 years and you took down payment assistance, depending on where rates are. I'll give you a call and go, hey, you might consider refinancing. Here's why. So by working with me or a qualified mortgage professional, we're going to help you decide by showing you the different loan options out there, which one is right for you and your family. So let's talk about the home buying process. There's basically 6 steps, okay? We'll walk you through these. We're going to be right there as your guide to help you through this. So basically, you have step 1, which I mentioned. I'm going to send you the mobile app, and you just go right there on your phone. If you prefer to do it on your desktop or your laptop, certainly can do it there. Complete that loan application. You're going to provide the required income and asset documentation, and then you're going to get that pre-approval letter, okay? I'm going to share it with you, and I'm going to share it with Ashley, your realtor, and then we're going to review your pre-approval with Ashley, and if Ashley's your realtor, and of course she is, and then we'll go over your purchase options. And then Ashley, she mentioned earlier, Ashley, go ahead and pop in here again, because that's going to be the next step. She's going to formulate that plan.
Absolutely. So once we figure out our product that we've got to help us purchase the product, then we are going to go house hunting. And it's so much fun because everybody wants to make changes to property, but it's a lot of fun. We get to go out, physically walk the property. And here's a huge tip. The internet.com is awesome for viewing pictures and those kind of things, but you really need to walk the property to actually understand the layout, to imagine yourself in the home after work, where you hang out, where you congregate, where's the Christmas tree going to go, where's Christmas dinner, where's Thanksgiving. So it really does help to actually be in the property and view it and tour it to make sure that the layout does fit your needs. And it's really lovely, Bruce, because it's sort of like I am a witness to people falling in love with their house. And it's a really neat feeling that I get to see and do. And we love, love, love when we're a part of that feeling and a part of that actual moment that's happening. You can't make it up. You can't make this up. I mean, it actually happens. But yeah, that's the fun.
And you know what? And you mentioned a great point. When you see them fall in love with that house. Now, this is why you're going to get pre-qualified. This is why you're going to know how much you can afford. This is why you're going to know your debt ratio. The last thing that you and Ashley want to do is go preview a property, go through it. You picture your family in this home. It's the perfect home for you, and it's out of your price range. You didn't get pre-qualified, but Ashley's not going to take you out and show you home if you don't have that pre-approval letter. But if for some reason, let's say you go look at a home and maybe the income, we're trying to use an income that maybe you shared something with me that's not accurate. So just really, we have to really do our due diligence up front, because you don't want to fall in love with a home only to learn, you're not going to be able to get it. So then we go on to the next steps. Like she just said, you're going to be working with her. You're going to, she will formulate an offer. She's the expert on the community. She's looking at what has sold recently, not only in the last 3 months, but in the last 30 days, because listen, the market has changed. The market has shifted. If she's not on top of it, the realtor's not on top of it, someone will make an offer on your behalf. And if they aren't on top of it, they don't know what they're doing, you're not going to get the home. So listen, that's why it's so important to have someone like Ashley who knows the community and knows exactly how much you need to offer that home and comes in with a game plan. There are other tips and different maneuvers that can be made that will make your offer look more attractive. Step 5, now you have had your offer accepted. Wonderful, great. Now I'm going to collect updated documentation from you to make sure we have the most recent 30 days pay stubs, the most recent 30 days of banking. And then I'm going to send you a link where you order your appraisal. This is the only thing other than a property inspection that you're going to pay for upfront in the loan. So Ashley will tell you about getting the property inspection done, and we will get the appraisal. The appraisal has to be ordered through the lender. You can't go out and hire your own appraiser. And listen, it's not part of the lender. It's a third party, but it has to have our lender's name on it. You have to go through them. So then you've got the last step, step 6. Guess what? Our underwriter has looked at everything. You got final approval. Congratulations. We're going to send you the closing statement. You're going to review that to make sure everything is exactly right. It's correct. The numbers, everything we went over. If there's been any changes, it's been notated. You're going to sign that closing disclosure, and then 3 days later, you get to go to closing. You have to wait 3 days after you sign that closing disclosure by law. That gives you time, a little bit of a cooling off period, and make sure you have time to review it. Then you go to closing. Ashley and I will talk with you and the title company. We'll schedule a time that's convenient for you. You go to closing, you sign the documents, they hand you the keys, and congratulations, you're a new homeowner, and you're no longer paying a landlord. You're not making a landlord wealthy. You're now paying yourself. Congratulations. And so, listen, I hope that this has helped you understand you don't have to be worried, that concerned about it. It's not as daunting as it may seem if you've never done it. We will walk you through every step of this, and most of it, 90%, is going to be done in front of the loan, up front, to make sure. And so you've got confidence when you go out shopping. So we talked about owning versus renting, why owning is better, because you are building equity and building wealth for you and your family. The pre-approval process, if you're just tuning in, if this is online, rewind it, and you can go through this step by step. We talked about your credit report, how that affects your interest rate, your down payment. We talked about the down payment options, including down payment assistance. And we talked about your closing costs and how you need to factor those in on top of your down payment. You've got other closing costs as well. So just because you have the down payment, make sure you got the cost as well. And we'll show you that on your fee sheet, full breakdown. Talked about the different loan programs and which one may work best for you and your family. Talked about your mortgage payment details, what goes into it, your principal, interest, taxes, and insurance. And then we just went through the 6 steps in the home buying process. You've been seeing a scroller here that tells you how to get in touch with us. You can schedule a consultation with Ashley right here. I'm going to show you a QR code. Yeah, and then go below, and you can also get it below here. And look at this. I believe you'll see our QR codes right here. If not, we can go back to them. There you go. Take a picture. If you're not driving, right? Take a picture of that with your phone. That will direct you straight to us. But you can see here, you can go to Ashley's website, dfwfriscohomes.com. Mine is simply my name at bruceklinemortgage.com. Well, that's just about it. I may have gone a little over 30 minutes, but you know what? I think we covered it all.
We
How
did
we do?
great. Did great. And I think we got a lot of good information in on the front end. So I don't see any questions tonight. So thanks so much, Bruce. I appreciate you.
Absolutely. All right. We'll see you guys in 2 weeks right here, 6 p.m. on Tuesday evenings on your favorite platform for first-time home buyers. Hey, tell a friend about us, okay?
Share
Thanks,
us.
Ashley.
Bye.
Have a good one. We'll see you guys. Bye-bye.
Bye.